Building wealth is about preservation of money as much as it is making more. You need to maintain what you have and build up as much capital as possible to see the biggest results when compounding your returns. If you don't manage your risk and lose half of what you invested, you set yourself back more than you think. Say you invest in a high-risk, high-beta stock, hoping to 10x your money quickly, but soon find yourself down 50%. Just to get back to where you were, you must double from where you are now. This becomes increasingly harder the further your investment falls. In this video, we will explore dollar cost averaging and why it is one of the best and safest ways of building wealth. The DCA method is one of the most commonly used methods in the investing community, and we will show you exactly why with real examples so that you can see how to build wealth and generate risk-adjusted returns. If you like this type of content, make sure to give it a like down below and consider subscribing to Wise Wealth for more personal finance and investing content. So without further ado, let's get into it. Let's say you have $20,000 in cash ready to invest in the stock market. You've found what looks to be a well-diversified fund that specializes in high-growth American stocks, ranging from technology to biotech, consumer discretionary, and more. You're so excited to get started that you invest all $20,000 on January 1st of this year. Unfortunately for you, timing is not on your side, and you have invested at the beginning of a market sell-off. Being in high-growth stocks, you have subjected yourself to a lot of volatility, and the diversified fund that you just invested in collapses 50%. Your investment has shrunk to just $10,000, and it's a long way back to breaking even, and you have to wonder if that was the best way to go about investing. But compare this to dollar cost averaging. How does the DCA method work, and is it more effective? If you were to dollar cost average into your position instead, you would start by investing, say, $4,000 of your $20,000 investment as an initial position. As the market sells off, you can average down into your position to lower your overall cost basis. This way, your principal investment is smaller to begin with, and therefore any overall losses you incur are ultimately lower as well. You could separate your incremental investments each week, month, or quarter, whatever works for you and depending on how volatile the swings are in the market. If you were to DCA on a monthly basis, it would look something like this. At the end of the investment plan, the fund has collapsed 50% as before, but your cost basis is much lower, and your capital has weathered the crash much more successfully than simply investing it all up front. This is a key method to preserving capital throughout a market downturn. A big part of succeeding at investing is making sure you are able to stay invested for the long term. If you can protect your capital from losses, you ultimately set yourself up for greater returns in the future. As Warren Buffett says, the first rule of an investment is don't lose money. The second rule of an investment is don't forget the first rule. So, you're able to invest your $20,000 with a lower degree of risk by dollar cost averaging over a period of time. Sounds great, but are there any downsides to this method? It simply means that if you DCA into a position and the market starts to rise instead of fall, you are increasing your cost basis or averaging up, rather than averaging down over time. This can result in capping your upside potential. You would see a greater return by investing it all up front, but this is not a sustainable way to generate risk-adjusted returns over an investing lifetime. If you ask any investor, the pain felt of outsized losses far outweighs the potential gain that they could have realized with being more aggressive with their investing decisions. Always thinking about how much money you left on the table is a quick way of exhausting yourself mentally when investing in the stock market. You can't successfully time the market every time. That is speculating, not investing. Speculating is putting money into the market in the hopes that someone else is willing to pay a higher price than you did. The DCA method allows you to create a structure when investing and instills discipline in your investment approach, a trait that is incredibly valuable for an investor with a long time horizon. Building wealth involves risk, especially when investing in stocks. You can never guarantee your capital when investing in a company. After all, they are called risk assets, but that doesn't mean that we should expose ourselves to extreme levels of risk in order to achieve strong returns in our portfolio. Risk-adjusted returns over a long investment lifetime should be any investor's ultimate goal, not the boom or bust YOLO mentality many retail traders have come to seek in the past few years through derivatives, leveraged bets, and short-dated call options. Exposure to a single company, stock, or sector, and trying to time the exact bottom in the market can ultimately result in wealth destruction. Sure, some people get lucky or find a diamond in the rough, but it is not a reliable method of building wealth for the average investor. Many will look at some of the most successful investors of all time and think to themselves, if they can do it, surely I can. But that dedication to investing takes a lifetime of relentless research and understanding in the financial markets, which most people do not or simply cannot dedicate their time to. Dollar cost averaging allows you to participate in the financial markets as a passive investor, rather than an active one. Active investors rarely outperform the stock market in the long run, and allocate so much of their time researching stocks, keeping up to date with the latest market moving events. They also let their emotion get in the way of their investing, which can increase frictional costs of a portfolio, such as brokerage commissions, fund investment fees, and more. This can dampen potential returns. Why active managers underperform the market is a whole other video in itself, where we can go into much more detail. If that is something that you would be interested in, make sure to let me know in the comments down below. Passive investing is a set it and forget it strategy that allows you to let your investments compound over a long period of time. More importantly, it frees you to pursue other interests, such as establishing your own business or spending time with your family. If you dollar cost average passively over a long period of time into the wider market, history tells us that you're almost guaranteed to beat 99% of all active strategies out there. So why risk your hard-earned money? Why worry about sector-moving events, earnings reports, news pieces, or share offerings? Why expose yourself to unnecessary risks? That is the beauty of dollar cost averaging to build wealth. On this channel, we discuss various ways of building wealth, as well as personal finance and investing tips. For those who still want to look for opportunities in the market in single stock names, I have videos covering them as well. If you got value out of this video, make sure to give it a like down below and consider subscribing to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.